After enthusiastically underwriting European bridge loans earlier this year, banks are now on the hook to sell down nearly 10 billion euros of exposure. But the weak economic environment and dysfunctional markets are forcing banks to come up with more creative and potentially painful solutions. Well, joining me now to discuss the options available and the likely costs are Michael Sharon, Global Head of Leverage Loans at Crédit Agricole CIB, and Reuters' own Global Head of Loans, Tessa Walsh. Tessa, I'm going to start with you. What are we talking about in terms of this bridge and leverage loan overhang, and what steps have been taken to move it already?
Well, we did originally see about 10 billion euros. We're down to about 7.5. Before the summer recess, there's been a range of steps taken which have already been quite expensive. And those include bumping up margins, discounting, and sticking in expensive alternative pieces of debt like mezzanine loans while the high-yield bond markets remain closed.
So, Michael, things have been going on, but what else can banks do to reduce their exposure to the loans they underwrite?
Well, their first point of call is the flex language they've given in the loan documents. This gives them the opportunity, as Tessa referred to, of increasing the margin and providing a greater discount than they initially offered to the marketplace. However, once a deal has closed and you've worked through all your flex, your alternatives start becoming limited. Ultimately, you can basically sell it at a greater discount, which then cuts into your yields. If you can't get it sold at a greater discount, you're holding it on your books, and then you've got to make some much tougher decisions. Some banks will choose to hold them on their balance sheets for a time period till the overhold basically clears, which could be 1 or 2, maybe as much as 3 quarters from now. But again, each bank is different, and each has a different policy in terms of how long they can hold a piece of debt.
Tessa, how much of a loss will banks actually have to take to get rid of this exposure, do you think?
Very good question. I mean, investors are taking a really tough line and they're really pushing banks on the levels that they're willing to accept debt at, which in many cases are well below banks' pain threshold. I think banks Michael's in a better position than me to talk about this, but banks' break even is roughly 94% of face value, and investors are taking a really tough line and asking for 92 to 90 and even down into 85 for some really big chunks of debt to take it off banks' hands.
So, I mean, Michael, it's a tricky question for you, but I mean, how much pain are you expecting to take?
Well, each bank has to take a look forward and say, well, where do I think this particular credit's going? If you think, again, it's going to remain stable or improve in light of the economic conditions, they may choose to hold. But if you've got, if you're looking forward, if you're in a construction industry, or it's a loan that's going out to some area that is not defensive, you may be willing to take that hit. And that hit could be below that 94, 95, 91 mark.
Can you think of specific examples there?
Well, at this point, no one has taken those hits. And what's going to be interesting is in this fall, which is September, October, November, before year end, before banks start putting together their accounting, they need to make a decision what that number is. So I think if you watch the marketplace, you'll start seeing those specific numbers hitting for specific banks. Again, an important piece to this is whether a bank has going to have to market publicly these loans or not. And if they do, and they're heading towards the year end, and the economy of both the United States and Europe is starting to deteriorate, I think their willingness to take a higher pain threshold will increase.
Tessa, are mezzanine loans a substitute here for high-yield bonds, if the market remains shut?
Yes, but no. The mezzanine loan market isn't particularly large. I think on certain deals that we've seen so far, it has been an option that's been considered while the high-yield bond market remains closed. But really, we're seeing the first instances of some action in the European high-yield market now. And I think given the cost of mezzanine, it's actually quite an expensive piece of debt to put in, and it's potentially less flexible than a bond. That if private equity firms can go for a bond, they probably will.
I mean, Michael, do you think there's enough liquidity from investors, both banks and funds, to place deals?
I think going forward, it's going to be very challenged. The banks right now are in a very tight position in terms of liquidity. They're not looking to do any significant underwritings, and quite the opposite. They're looking to do, as we're discussing here, to shed both any overholds they have, and maybe even look to prune some of the other portfolios. So consequently, their appetite for increasing the liquidity in the marketplace is pretty small. And then you've got your CLO investors, which again has not grown at all since the first implosion or dislocation in the marketplace. So the amount of places you can turn to for liquidity is shrinking quite significantly. That's why the capital markets and the high yield bonds, and then other funds such as market value funds and hedge funds, insurance companies are very important because they're basically your last source of deep liquidity in the marketplace.
Tessa, I mean, so given that situation Michael's described, what effect does this have on M&A?
Well, it's undoubtedly a drag and a dampener, really. I don't think many banks are going to be willing to underwrite new transactions while this overhang exists. So we already know of lots of private equity sales, potentially, the EMI transaction and a few others that are dragging out for months and months, and there are real question marks over the size of debt that you could underwrite. I think you'd have to be quite brave in light of Michael's recent comments on liquidity, just to sort of bet that you could place all of that paper at the price that you want to right now.
Do you agree with that, Michael? Is it going to be hard?
I think it's going to be a challenge. I think you're really going to need probably 2 or maybe 3 quarters, and ultimately you may need alternative sources of capital coming in. I mean, ultimately, if some banks get so eager to sell the debt at yields that are attractive, you might even find people who are traditionally work between both private equity and debt coming in, someone like an Apollo, who you can sometimes act as a private equity investor, but also as a debt provider, and they're looking really for high IRRs. So someone looking for a good internal rate of return, who may be more on an equity side or more being subordinated debt area, may move into senior debt to provide liquidity if the yields get high enough and the banks are willing to sell at a low enough number.
Okay, Michael Schoen from Credit Agricole CIB and Reuters' Tessa Walsh, thanks both for joining us today. Do stay with us. At midday London time, we'll bring you the up-to-the-minute breaking news and analysis with comments from Jens Larsen from RBC Capital Markets. I'm Steve Clark. This is Reuters.